Hello, everybody. How is everybody doing? Welcome to the session, everyone. Today is July 7, 2022. And we are ready to spend, let's call it 45 minutes or so, maybe 30 minutes. We'll see how it goes. Talking about the markets, this is our Tiger Live session. We like to call them SMARTT, which stands for Special Market Analysis Report for Tiger Trader. And the reason why it's smart, well, I guess is because we are approaching the markets smartly. We are going to be using a lot of options data to understand what's happening in the markets. So our market analysis is not limited to looking at candles or charts. We are actually looking behind the scenes to what's happening in the derivative products and extract options data to produce a unique market commentary and analysis so we understand well the market conditions out there. Apart from that, since we are going to be using options and talking about options, we will have a mini options lesson as well within our Tiger Live session. So feel free to interact with me, feel free to work with me with questions and answers so I can help you better as I go through the presentation. We can have Q&A at the end if you wish, but I kind of like better if you guys shoot questions at me on the fly as we are going through the session. Okay, so let's begin, and again, be ready to interact. Please do not be shy, no matter if you are advanced or you are new to trading. I myself was new to trading at some point in the past, and these days, you know, it's been years trading the market. So happy to listen to your questions and happy to help you with answers and anything you guys may need. If you have suggestions for future sessions as well, again, happy to hear, so I can help you better. Very good. So let's begin with our session. Sorry, I forgot to point at the disclaimer that we have on the upper left side of the screen. As always, I guess if you are used to attend and be part of financial presentations, you know there are always disclaimers. So this is ours. Hopefully you read it. I am counting on you that you did. Anyway, agenda. The plan for today is I'm going to introduce myself very quickly, very briefly. From there, we'll move into understanding what's happening out there, key headlines. Then we'll move into the options, a lesson for the day. Then we'll do the market commentary itself. I have a bonus for you, which I'll be sharing later in the session. And then, as I said, we can have Q&A at the end, but probably it's more efficient that we cover questions as we go. I am watching you guys on YouTube. I am watching you guys on the Tiger Broker app, meaning that I'm monitoring all the chat boxes out there. So, you know, go for it. Okay, I'm watching you. If you need anything, I'll be grabbing your questions and helping you better. By the way, and this is going to be a request, not a question, but I think it's nice, it's kind, it's a good way to get started, to make sure as well that everybody hears me. I also make sure everybody has their apps working well and everything else. Please type a quick message on the chat box, a quick hello. So I know you are there, I know you listen, I know that typing and chat box is working fine. That would be appreciated, and that way you also tell me this way that we are ready to begin. Okay. Before we go to the next slide, I also wanted to point at the QR code that you can see on the screen. This is a nice one coming from Tiger Brokers that allows you to trade US options with no commission. It's a zero commission card for US options trading. So grab that coupon code if you didn't grab it yet, and therefore you can benefit from such nice benefit. Very good. So let's begin with the introduction. So my name is Jose Blasco. I am a multi-asset trader. I trade all assets. If you've been in my sessions before, you know my preference, my love, if you wish, in the marketplace is really relying on the options. I love all assets because they all are great in many ways, but they also all have disadvantages. And one of the things that I love about options is that I always joke and say options give you options. You can set up all sorts of option strategies that adapt to market conditions. You can massage your trades during the life of the trade. In case a market or a trade goes against you, you can work on it to hopefully give the trade a second chance and end up not in a losing position, but end up in a profitable position, or at least end up with losses, which are lesser than the losses that you were planning in the first place. So again, with options trading, you can do many things which are very cool. And I would say I'm pretty positive you guys are also excited, and that's why you're attending these sessions. But again, happy to share more and more as we spend time together, and to help you best, as I said before, share with me, guys. Don't be shy, share with me. what are your struggles, what are your needs, what is it that you're looking for, so I can produce and prepare future lessons as well, where I can address your needs. Okay, so speak up. I shared my email address at the beginning of the session as well. Feel free to use it in case you want to keep your suggestions anonymous. Instead of typing on the chat box, you can obviously send me an email, and definitely very happy to communicate with you this way. Okay, our website, tradewithufos.com. For the ones of you new to the Tiger Live sessions with me, you may be like, UFOs, what's that? Well, if I zoom in here, well, actually, I cannot zoom in. I'm used to another tool. So if you look at the little chart on the upper right, so that little chart on the upper right, you can see those flying saucers. This is what we call the UFOs. We got the red UFOs, the green UFOs. Those are buy on field orders. Those are sell on field orders. And obviously, this is a fantastic tool to add precision to your market timing. It applies to all trading styles and so on. I use it all the time. What I'm teaching you concerning options does not require the use of the UFOs, but that's what I do, that's what we do, that's what I love, and therefore I'm gonna use them throughout the session today. Even though you may have different trading techniques, and it's fine, you can certainly use your trading techniques combined with options. Okay, so the lessons that I'm producing for you guys are universal, no matter the tools you use when trading, no matter the trading methodologies that you operate. Even though my preference is the UFOs. Okay, so headlines, quick one. And if you are new to my sessions, you may not know this. If you are a part of my sessions from time to time, probably you've seen my very pragmatic approach to understanding the markets, and you can see that today with the headlines, a very short list and very straight to the point. Instead of talking about a million different news that may or may not have an impact, that may impact in one way or another, and is all subjective and subject to interpretation, and who knows what's going to be. Instead, I am focusing on the things that are really, really, really relevant. And then apart from the things that are very relevant, later we'll jump into the real-time charts and we'll do our market analysis using options data. And with that, we're going to take things to the next level. Okay, but what's going on out there? Nothing that you don't know probably. So Russia-Ukraine geopolitical tensions still there. Huge impacts in prices of commodities such as oil. So big time impacts. The fact that the dollar recently has been moving a lot actually has not impacted that much the Russian ruble, that has been moving a lot as well, impacting indirectly the prices of commodities such as crude oil. So again, these particular headlines are indeed impactful, and while this is out there, things are happening and things are going to keep happening. Okay, US fighting inflation. So we've seen rate hikes. They are also discussing other countries such as Australia, the Eurozone, to also raise rates at some point. So again, pretty big fight between the currencies. But I have to say that so far, we have a third bullet point there, extremely strong US dollar, which is weakening most of the market. So in the prior Tiger Live sessions, I talked about how the dollar was strong. Today, I added the word extremely strong in front of it. I mean, it brought the euro, for example, down to 101 something. So again, it's almost back to parity, which is something that we haven't seen for ages and ages, right? So what happens when the dollar becomes stronger? Well, since the majority of markets in the world are priced in US dollar, then the majority of markets go down. Why? Because you need less of those dollars to buy that market. Why? Because the dollar is stronger. So stocks go down because you need less dollars to buy the same stock. Cryptocurrencies go down. Why? Because you need less dollars to buy Bitcoin, et cetera, et cetera, et cetera. And therefore, we have seen a very, impactful situation out there with the very strong dollar that now is extremely strong. And I'm using the word extremely on purpose because extremely also means getting to a point of, not being sustainable from a statistical point of view. And therefore, there is a very strong possibility right now where a bullish wave starts developing in the marketplace, which I'll discuss more in a moment when we look at the real-time charts. Okay, so I will refer back to the dollar and you will understand what I mean. Very good. I see your question there, Lasik. I'm coming to you in just a moment, okay? Today we got 27 earnings reports today on July 7. Now, having said that, nothing is too relevant today. So most of the companies reporting earnings are relatively small caps, nothing that relevant. So of course, if you happen to hold any of those 27 stocks, so earnings reports are always relevant. But I'm talking about the market overall. Really, those earnings reports today are, you could basically kind of like ignore them unless you are invested in those stocks. Okay. So I won't spend too much time. So the lesson for today is about historic and implied volatility. But before I get there, question from IASIC. I have heard about options, but I'm curious, who are the ones that put them up for others to trade them, to take them? Could it be from a powerful financial institutions that can affect the prices to their favors? My pleasure, IASIC. Very good question, by the way. And basically, the entities that are taking the other side of our trades, all trades, no matter the trades, no matter the product, is what we call the market makers. Okay, so the market makers are typically financial institutions that may or may not have a conflict of interest against the traders. So there may be times that a financial institution may be trading and have a directional bias on a market, and they may be taking the other side of your trade. So when you buy an option, they sell it to you. When you sell the option, they buy it from you. And if they are trading those options in a certain direction, there may be a conflict of interest. And because they may have access to large size and tools and co-locations in the same buildings as the exchanges, and they have less latency to execute orders and things of that sort. So they may create a little bit of legal trouble to the retail investors because they are in a position of advantage, if you wish. Regulation tries to avoid that, but technology allows for a little bit of this to happen, and much less than in the old times. In the old times, it was crazy. Having said that, the majority of the market makers, they are not in the business of trading against clients and trying to make life difficult, because markets are very efficient. Markets are very large. It's actually very difficult to manipulate markets, even if you're a large market player. So basically, what the market makers are playing is a game called arbitrage. And basically, if you want to buy a call, they sell it to you, but they sell it a little bit higher, and then they buy stock against. So if the market goes against you, because they own stock against the call they sold you or bought from you, so then they don't lose against you because they're hedged using stock against the option. And then what they do is that they keep the difference between the bid and the ask price, which is the arbitrage opportunity. And they do that many times a day. And it's a fantastic business for them. So, I totally understand out there that there is, people that claim and try to scare people out of certain markets. Sometimes, if I could share, and I don't mean it in a bad way, but I've seen, practices that sometimes go a bit too far. So I've seen, for example, trading educators at times trying to scare their clients, right? And say, institutions are going to beat you all the way, and you need to come with me, and I'll teach you how to trade. So you can have an edge and things like that. Well, there is some truth to that, because trading without being educated would certainly be a problematic situation. The reality is that the markets are so efficient these days that it's difficult for an institution to have an edge, directionally speaking. The benefit they have is that they have so much capital, and plenty of the capital does not belong to them. It belongs to their clients. So in that sense, they have a big advantage. But when it comes to predicting what the market is going to do in the next day, in the next 5 minutes, in the next 5 months, they use the same tools we use, and therefore it's not like they have an edge. Okay, so again, being a market maker is basically a risk-free business if they operate the way I have described, even though there are different techniques on how to operate. But basically, it's a risk-free business where those large market makers, they always collect and lock in the arbitrage opportunity, which is basically the difference between the bid and the ask price. And they do that by hedging options trades against stock, and therefore there is no conflict of interest, and it's a very safe market, okay, to trade, as long as you are educated in the sense that you know what you're doing, you know what's a call, you know what's a put, you know how to manage your risk, you know how to calculate the right amount of calls or puts to trade given your portfolio, to manage correlation risk. I mean, you gotta be prepared to trade powerfully, but I would say there is not a real need of, fearing the markets like there is I don't know how to say it, like one of those, very negative theories out there that, everyone from the retail group is going to get hurt. That's absolutely not the case. Okay. In the 60s, of course, you had to trade on the New York Stock Exchange with what was called the specialists. There were no computers, and of course, now you had a human being dealing with the orders. And of course, there was market manipulation all the way. And in that sense, yes, but that was in the 60s. When the markets become electronic in the 90s, all of this has disappeared basically. And, markets are fantastic these days. Very good. I am disappointed with Kathy from ARC and answers that the US has already a recession when the GDP report was not honest. Okay, I get you. And the thing about defining terms such as recession and things of that sort often is that there is plenty of subjectivity in those terms. So many market analysts, including myself, many market analysts, we use the same word with different meanings. So certain market analysts may use the term recession based on a certain definition from a certain university, from a certain place in the world, which defines recession as something, where someone else defines recession as something else. And that adds subjectivity. And sometimes, two different market analysts saying the opposite thing, they're both right, because basically their basis for the terms they use is very different. So in my case, as you will see later in the real-time charts, I'm going to be very pragmatic, very objective with the top of market data I'm going to put out there. And basically, I try to avoid using words that are too generic, such as recession, even though, of course, it's definitely an important word. And certainly in a certain context, it could mean a lot, and for the good or for the bad, depending on how you use it. But from a trading point of view, I'd rather be disconnected from such type of words, because they may generate a lot of negativity, a lot of positivity, which unconsciously may bias me to only be a seller, to only be a buyer, to be fearful, to be overexcited, depending on my views. And as a trader, I want to be neutral. I need to control my trading psychology. The ones of you trading for a while, you know how important that is. And in order to control trading psychology, I need to rely on objective data instead of words that may have a human meaning beyond what the market should mean for a trader when it comes to not being impacted by trading psychology decisions. Okay, guys, let's go into the lesson, because this is a fantastic conversation to have. Thank you so much for this question. I could talk about this for hours, as you can see. It's important stuff, but let's get into our nature of the beast lesson for the day. And you're going to be like, nature of the beast, what is that? Okay, well, let's first begin with understanding historic and implied volatilities, and you will see where I'm going with the concept of nature of the beast. So first of all, volatility from a generic point of view refer to the speed of movement of a stock, for example. Okay, so if a stock is volatile, it means it moves very fast. If a stock is non-volatile, it means it's moving very slowly. Volatilities are often attached to risk, right? Because when a market is very volatile, it could move against you very fast. And indeed, there is a source of risk when you think of volatility, but there is also a source of opportunity, isn't it? Because if the market moves very fast and is moving very fast in your favor, then it's great. I personally, certainly like volatile environments. I have no problem with that at all, especially when using options. There are certain option strategies, okay? And in a volatile environment, what I'm about to say is not ideal, but bear with me. So if you buy a call, for example, in a volatile environment, it's going to be very expensive, so it's not ideal. But again, let's pretend you find a call which is fairly priced. So in a volatile environment, you buy a call, and what's the most you can lose? It's whatever you pay for the call. Even if the stock goes all the way to zero, you cannot lose more than what you pay for the option. So if the market is very volatile, and worst case, you're going to lose that amount. And if the market is very volatile, which means best case, the market is going to reach your target very quickly, and then you close the trade, take all that beautiful, nice profit, and go plan another trade. So I guess you get my point. There is no need to be motivated to trade volatile markets. Having said that, we need to understand the nature of the beast, which is the whole point, behind today's session. So volatilities, okay, and the reason why we need to understand the nature of the beast is because, maybe if it's one of those Japanese monsters that you see in Japanese movies, so maybe you want to stay away, right? Now, if the monster, if the nature of the beast is going to be, I don't know, some powerful creature, but it's not a monster, so then, you're going to be happy to trade it, isn't it? So again, we need to understand the type of environment, the type of instrument that we trade, and that's what I'm calling the nature of the beast, which I'm going to be more concrete in a moment. Okay. So volatilities, which refer to speed of movement, they need to be measured, and they could be measured in many ways. So you could say that stock is volatile because it moves $5 a day. That stock is volatile because it moves 5% per day. That stock is volatile because it moves 5 standard deviations per day. So again, you could measure volatilities in many ways, and those calculations could be extracted out of looking at the stock price, or could also be extracted out of looking at the options prices. So you may look at the stock price and how the stock is moving, and you may be like, okay, that stock is moving at that rate. That's the volatility, and that's extracted by looking at what the stock is doing in the real world. Or you could be looking at the options prices, and by looking at the options prices, you would be like, wow, people are paying that amount for the options. That means people are expecting that move, right? It's a huge move. So, I mean, I remember we had a lesson a long time ago where I was showing you the options on McDonald's and the options on Facebook at that time, that now is called Meta. And those were two stocks trading around $200 per share. They were both more or less the same price. But then the options on Meta were way more expensive than the options on McDonald's. And why is that? See, if the stock is more or less the same price and we are looking more or less at the same expiration date, how come the prices were so different? Well, because there was more expectation of volatility built in Facebook than the expectation of volatility built in McDonald's, which is a more, let's call it, stable company. People buy burgers no matter what, where social media may experience ups and downs, as the technology industry as a whole is more impactful, right? Is more impacted by the change in the market dynamics. So the historical volatility, it's the volatility which is calculated out of looking at the stock price. So we look at the stock price as a reference and we calculate the historic volatility. I will not get into how the formula is applied because it's complex, but basically I will get into what the number means. You can see my example in the bottom part. We got a blue number there, which is 18.51 for Coca-Cola Company, which is the stock I got in the bottom part. So what does that mean? Well, it means that having a historical volatility calculation that points at 18.51 represents that the expectation for that stock movement would be, the speed of movement for the stock would be either up or down. The expectation for speed of movement would be 18.51% in 1 year. Everything in the world of options, and therefore the world of volatilities related to options, everything is tied up to yearly moves. And then we can break it down. If you later at 8:30 p.m., I will have my colleague running our 3D market commentary. And if you attend, you will see how he talks about the expected volatility in points per day, per week, and per month. Well, in this case, we are looking at the expected volatility in a yearly basis, which then you can reverse engineer and get the daily move, the weekly move, the monthly move. But the way it's calculated by default is looking at yearly moves in a 1 standard deviation case. In other words, assuming anything could happen, which is a standard deviation, which is a normal distribution of price. If you look at a 1 standard deviation of a normal distribution, and sorry to drive you crazy if you're not into probabilities and math and statistics, I'm trying to simplify this. So in a world where anything could happen, a 1 standard deviation represents more or less 68% of the cases. So therefore, this calculation tells you that if the stock remains behaving the same way it has behaved in the past, 1 year from now, that stock should be either up or down 18.51% in 68% of the cases, which is a normal thing to happen. That's why it's called a normal distribution. It's a normal thing to happen. Now, this is assuming the stock remains and behaves the same way it's behaved before, okay? Because historical volatility is extracted out of looking at the stock price as a reference. So we are looking at the past, we look at the speed of movement in the past, and if that was to continue into the future, then that stock has 68% chances to be either up or down by 18.51% in 1 year. So that would be the expected volatility based on the stock price. You may be thinking, why is that important? Well, I guess there are many reasons where we all understand why it's important, but if we think about options trading, which is the lesson for today, you may be thinking, why is that important? Because this is related to the stock price. Well, you'll see that in a moment. Take a look at implied volatility. The implied volatility is another volatility measurement. It's also a percentage. You can see below with a red color, you have Coca-Cola stock pointing at 31% volatility. Okay, right next to my right eye, right there, 31%, isn't it? So what does that mean? Well, it means that we expect the stock to be either up or down by 31% in 1 year in 68% of the cases. But to reach that calculation, to reach that conclusion, that number, the information that was used is not the stock price movement in the past. It's the current price of options today. So you look at the options prices today and you reverse engineer the options pricing model, you end up with 31%, which is the implied volatility, is the volatility which is built in the options prices, is implied the options prices, and it represents an expectation for a future move based on what people are willing to pay today for options. So notice that if I go back to the prior slide, we got Coca-Cola is moving when it goes the fastest at 18.51%. Back in January, February, it was moving down to, I don't know, let's call it maybe 14% or something like that. If you look at the blue line in January, February, it's like maybe 14, 15%. So the nature of the beast, being the beast Coca-Cola company, the nature of the beast is when the beast is asleep, is moving at a rate of 14. When the beast is awake, it may run as fast as 18.51%. That's the nature of the beast. That's what the stock has shown and proven to be capable of by showing that in real price movement that we can put on a chart and see, because it's real stuff. It truly happened. So when this beast is asleep, it's moving at a rate of 14. When it's awake, it's moving at a rate of 18. But based on the options prices right now, people are expecting Coca-Cola to move at a rate of 31, which is kind of like not double, but almost double the fastest speed at which Coca-Cola has been proving to be capable of moving at. In other words, those options are very, very expensive, my friends. The options buyers at this moment in time, they expect Coca-Cola to move at a rate of 31, where the fastest rate at which Coca-Cola has been proving of moving at is 18 point something. So probably they're wrong. And probably selling those options is going to be a very good idea, because they're probably going to deflate and go back to the mean, like every single time on the red chart where you can see options went to 31 or 30 or something like that. Every time it dropped back down to, let's call it the mean. So volatility rises up all the way to 31 something. And what happens next? Drops. Why? Because it's way too much expectation given the nature of the beast. You expect that beast to run at a speed of 31, where the maximum speed is proven to be capable of moving at is 18. Okay. So now, could it be that the stock has a merger? Could it be some external force which is massive, acts, and the stock, next thing you know, gaps down 20% in 1 day, and next thing you know, the historical volatility rises? Yes. But is it likely? No. That's the beauty of statistics. Okay. You got 68% probabilities of the opposite. So we are comparing expectation versus reality. Historical volatility values represent the stock speed of movement reality. It's real because it truly happened in the past, where implied volatility values represent the expectation for price movement into the future. Remember, the implied volatility is extracted from today's options prices. There is no past data there. It's real-time options prices tell you Coca-Cola has an expected volatility of 31. Okay? Where the historic volatility is based on the past data, which is real. It truly happened. So by comparing what the stock has proven capable of doing, which is the historic volatility, comparing that value against the expectation of what is believed the stock will do in the future out of implied volatility by looking at today's options prices, doing that comparison is a healthy exercise so you can understand if your options are expensive or cheap. Why? Because let's say you buy an option which is very expensive. Now the stock moves your way. Congratulations. But if the option shrinks in value because it was too expensive, if the option was trading at 31 IV, and then the option is going to drop from 31 IV to 25 IV, right? You got 6% drop on the IV. That is going to shrink the value of your option. So even if the stock is moving your way, your call is suffering. Why? Because it's losing value as it was overpriced when you purchased the call. So in order to understand what's expensive and what's cheap in the options prices, you got to understand those volatilities so you can do proper assessment when trading options. Okay, so it's all relative. You can see here another example here with the VIX and Apple. So VIX is the implied volatility of the market, which is currently at that time on the screenshot trading at 26.95%. Now Apple got a volatility of 35%. That's implied volatility. Many options traders would say, wow, 35 is more than 26, right? That's very expensive options on Apple because it's more than the VIX. But the VIX does not represent Apple. The VIX represents the S&P 500. It does not represent the beast. Who is the beast? Apple. So let's look at the historic volatility for Apple. The historic volatility for Apple, now I'm plotting it with a cone, which is a different way to plot it, but basically it's the blue lines. So notice how the blue lines, which is the historic volatility, generate a wider cone compared to the red line, which is the implied volatility, which generate a narrower cone. In other words, the speed of movement of Apple in the real world is more. Apple can move faster in the real world than what options are being priced off at this moment of the screenshot. Therefore, options are cheap. Buying options on Apple at this moment in time could be a great idea because you are not buying overpriced options like in the case of Coca-Cola I showed you before. Okay. So again, very important lesson, and I'm going to show you this real time in a moment. Okay, and you will see that better. Okay, so now before we move to the real-time charts, I said that I had a bonus for you. So here's the bonus. One of the tools that you will see me use in a moment is called Auto Climate. It helps me to understand the market cycles, the climate. Is it sunny? Is it rainy? Time to trade, time not to trade, time to go out, time to stay home, time to go long, time to go short. We call this Auto Climate. This is a free tool that you can find on our website. But while it's free, there is an activation fee, which thanks to our collaboration with Tiger Brokers and you being a Tiger client, we put this coupon code CLAIM8 at your disposal. So you can go out there and you can actually utilize this coupon code, and Auto Climate becomes totally free and it's free for life. And now you can use that using TradingView, which, by the way, TradingView could be connected to Tiger Brokers as well. So you get the market data, you get the execution as well on TradingView if you want to. So take a look at this, and again, I'll use this tool in just a moment. I'm gonna stop sharing the PowerPoint presentation, which also means the live video stream will go away, so you won't see me, but you will see my trading platform, so I can do the market analysis and go a little deeper into the lesson as well. So I am sharing my screen now, so I believe you should be able to see my screen. I will just wait to see that is the case. I believe so. Yes, it is the case. Fantastic. So, so let me take a look at the real-time markets. Okay, so here's the real-time markets, and here is SPY, the S&P 500 ETF. So notice what I got here. I got the probability cone. Okay, by the way, in case you are wondering, I'm using TOP, the Tradictive Options Planner. Okay, we call it TOP. Is our options planner that builds options trades for you automatically. So if you want to take a trade with the S&P and you don't know how to trade options, you right click, you send the trade to our strategy builder, and it's going to build the options for you, including the spreads that are going to be built for you automatically here. So then you can just sort based on return on investment, and you're like, okay, this trade can make for me up to 113% return. If I'm right, let's go for it. Okay. And you know, again, I just wanted to flash this in case you were wondering what this tool was. In any case, going back to the lesson today, I'm using the probability cone applied to SPY, which is the S&P ETF. So what do we see? We can see how the red line is inside the blue lines. That is not always the case. If I switch, for example, to, let me look at Meta, for example. So if we look at Meta, so what happens? Well, notice how in the case of Meta, okay, the red line is a little higher, is not between the blue lines, okay, it's not inside the blue lines, it's between. So a way to think of this is that the options on Meta are fairly priced. They are not cheap, they are not expensive. What if I change to Apple? So if I change to Apple, so notice how the options are cheap. The red line is inside the blue lines. So the implied volatility, which is the red color, the expectation for a future move is less than what the stock is proving capable of doing. The nature of the beast is more active than what the options prices show. So options are cheap. Okay. If we look at Alibaba, for example, so here we are talking about also cheap options. Okay. If we look at McDonald's, we are looking at options that are, getting expensive. The red line is all the way when the blue lines end. Okay. If we look at Merck, for example, a biotech company. So notice how the red line is also above some of the blue lines, but still within the blue. So it's expensive, but not that expensive. So you get my point, right? So understanding the nature of the beast, understanding what the stock is capable of doing from a historical point of view and compare that with the current real-time implied volatility tells you if you should be an options buyer or you should be an option seller to avoid buying overpriced options or avoid selling underpriced options. So you're in a position where when you buy options, they are cheaper. And when you sell options, they are more expensive, which puts you at an advantage instead of just buy calls just because, and you don't even know if the calls were expensive or cheap when you bought the call. Okay. So very important lesson for today. And hopefully it made sense. Okay, but now we need to move forward with the session. We need to do our SMARTT market analysis report for tiger traders. Okay, so we're gonna look at climate, implied volatility comparisons, volume map, UFOs, all sorts of things. So let's do this quickly. Today, to be honest, the analysis is gonna be quite short and simple because today is a day basically to be a bit patient, as you will see. So what are we looking at? Well, the first chart that I'm showing you here is the S&P futures. Okay, and the S&P futures is currently trading at 0.39% up compared to the close yesterday. So we are likely going to see an up opening in the market, and that's nice. And we got UFOs on floors to buy below. So if the market was to fall and come here, so you got basically 60% probabilities, the market would bounce and go back higher. So again, the market is looking like it's going to open higher and continue moving higher. And if it was to try to go down, probably it's going to find support and go back up. Okay, that's what we are about to see, which is very much in line with my comments about the dollar index earlier, when I said the dollar index was too stretched to the upside, and therefore is likely going to correct. So if the dollars become weaker, then the markets will go up because you need more dollars to buy the market because the market is priced in dollars and the dollars are weakening. So that is a very likely possibility based on this analysis. Now, to be more specific, we are now looking at the auto climate, and we can see we have a blue dot, which means that the climate is up. But notice this is a thin dot. It's not like those here that were thick dots. All those blue dots are thin. All those blue dots, they are all thin, which means the climate was not confirmed to the upside. Today is not confirmed either. So that's why I said we need to have a little bit more patience. Could you trade? Of course you could. You could also do intraday trading. You can do many things. But if you're looking at the daily time frame of the S&P, we need a bit more evidence that this move is going to continue. So we know the market will open gapping up, and right at the open, auto climate may give you a confirmed indication. And if that's the case, let's plan trades. But if it's not the case, being patient is probably a better choice because we don't have a statistical advantage given the fact that the climate is unconfirmed with the thin dot. Now, having said that, if the market opens gapping up and at the open, we have a new dot that show up here. Okay, a new dot right here, which is thick instead of thin. Okay, and again, you get auto climate for free on TradingView, so you can get that and see it in 1 hour time, 1 hour and a half. Okay, I believe it's very likely when the market opens we're going to have a thick dot. But what's very important to me, and now we are talking about options data, is the fact that here below I have the implied volatility that we just learned about in the lesson, but I have it break it down into two. Instead of implied volatility, which is the implied volatility for the options, I got in blue color the implied volatility for the calls only. And in gray color, I have the implied volatility for the puts only. So what happens is that for a long time, you can see the gray line was above the blue. Okay. The blue line went above the gray for a little bit, but immediately the gray line went above the blue again. Okay. And what's happening now? We are back to the blue line above the gray. Now, when that happened here, that the blue line went above the blue, the blue line went above the gray, we were in a down climate. So that's why it came back to gray above the blue. But right now, we have the calls winning the battle. Okay, there are buyers entering the market. We can see that thanks to the options data. And while buyers are entering the market, the climate is blue. Just happens to be non-confirmed, but it's blue. So if the market opens gapping higher, which is likely based on the futures, therefore we get a thick dot, which is likely based on the futures. And we know we have buyers in the market because the options markets are revealing that there is more buying of calls than buying of puts, which is bullish. And there are buyers building up from behind the scenes that we don't see on the charts yet, but they are in the options markets. So we may now be dealing this together with the dollar index changing direction. We may be dealing with a complete change of direction. And now we are back in a bull market. That's what I could see happening. Now, there is a component of anticipation on my analysis today. So everybody, please take it easy. Get your free auto climate on TradingView so you can confirm that. Because what we need here for everything I said to be true is we need a thick dot. And I will not know that until 9:30 p.m. In Singapore, which is 9:30 a.m. in New York. So I need to wait for the new candle to start so I can see that auto climate dot. Okay. So note of caution, even though it's looking like the market is really adding lots of healthier components than what we had before. Another thing that I wanted to mention here is the fact that now we are looking at the SPY ETF, not the futures, on intraday timeframes and looking at the 34-minute time frame. So in that intraday timeframes, we have pockets of buyers. Okay, just like in the futures, back to the futures, we have pockets of buyers in intraday. With the SPY, we also have pockets of buyers on field orders to buy with the UFOs. So all of this means that if the market is likely going to go higher, but if the market tries to go lower, we should find support quickly and go back higher. And on top of that, with the buyers coming into the options markets, so again, it's all really depending on these dots. If we get the thick dot today, it's very likely the markets will continue higher for a full climate, which is at least 6 days, based on statistics. If we don't have a thick dot, then we need to wait and see what happens the day after until we have a thick dot. Okay, we don't want to be the guy carrying the flag in the front line of the war, but certainly we want to be close to the action, and we need to find that balance. Okay, which is what I'm suggesting here. Options on the S&P, as you can see, with the red line being inside the blue lines, are cheap, which means that no one is really scared. When people are scared, when the markets are crashing, let me show you, for example, when the markets were crashing here. So if I move my cone to prior dates, so what was happening at this moment in time, for example? Okay, that day, for example, when the market is crashing, following a gap, notice how the red line was way beyond the blue. There was fear in the market. What do we have now? A pretty calm situation where the implied volatility is clearly way inside the blue lines. So options are fairly low price, and we can see buyers coming into the market. Okay. Also, when we look at volumes, to be honest, volumes are not revealing too much today because both the call and the put are beyond the little triangle. So they are above their average volumes. So there were many calls and puts traded, both. That's why these two lines are relatively close to each other. But while those two lines are relatively close to each other, the calls are winning the battle, having the blue line above the gray. So again, we can see those buyers coming inside the markets, okay? So last comment, and I will complete the session for today. No, not this one, sorry for that. Clicking the wrong button. So the grouping. So both midterm and long term, we still see the markets being fairly weak, okay? But we can see some sectors like utilities still in the red, but gaining strength, okay? Some sectors gaining strength, some sectors gaining strength, and long term too, long term too, long term too, okay? Long term too, long term as well. So again, certain sectors are not advisable. They're still losing steam, going down, So those are not advisable, but you can see there are a few sectors such as healthcare, utilities, consumer goods, technology, where those sectors are showing signs of willing to recover. So the moment we get a rotation, okay, in a future session, we'll talk about it and I will let you know. So far, we don't have a rotation yet, but notice how utilities seems to be almost ready to rotate and give us a blue bar. And again, if we get a change of climate on the S&P and we start seeing sectors to start rotating, my friends, that will probably mean that we are back in a bull market and the bear market is over. It's a bit too soon to say, but it's looking like it's coming. So the wise trading right now, as said, I will re-summarize it for the last time, will be wait for a bit more confirmation on the climate. So you can take a few long trades. Okay, but while there will be long trades, don't keep them for too long, 6 days or so. Do swing trading. Don't do long-term investing yet because the groupings are still not showing sectors that are clearly rotating, and therefore we may be dealing with a wave to the upside, like what we had here. That was like around 6 days going up, something like that. But then another very strong push to the downside. So this could still happen, even though with the blue line above the gray, we are now having supporting elements to change that. Okay, so the following days, couple next weeks are going to be quite critical. So I will be back later in the month in another Tiger Live sessions, and know that every day at 8:30 we do our market commentary. So stay tuned, watch us, listen carefully so you understand the market environment, and follow us and like us on the Tiger Broker community, guys. We are posting articles and educational posts every single day with great trading tips that could be very helpful to you guys. So find us on the trading Tiger Broker trading community. Look for Tradictive, which is our company name, and follow us. And again, talk to us. Happy to help you. See you in the next one, everybody. Thank you for joining me. And Tiger Brokers, as always, thank you very much for being our host, facilitating the session, allowing us to connect with a fantastic community in the Tiger Broker environment. And here's one last time the QR code for you to take a screenshot if you haven't yet. And don't forget the coupon code CLAIMATE so you can get your auto climate free forever. Everybody, take care. See you soon, and bye-bye.